Hey there, investors! Today we're diving into the exciting world of emerging markets. These economies offer incredible opportunities for those willing to take the plunge. We're talking about calculated risks and potentially huge rewards. Emerging markets are like investing in a startup. There's risk, but the potential upside is enormous. These markets are brimming with young, driven populations and a hunger for innovation. So, buckle up, because we're about to explore the ins and outs of investing in emerging markets. So, how do we define an emerging market? It's not just about geography, it's about potential. We're talking about countries experiencing rapid industrialization, modernization, and economic growth. Think BRICS: Brazil, Russia, India, China, and South Africa. These powerhouses are often the first that come to mind, but the emerging market landscape is vast and varied. We're also seeing exciting developments in countries like Mexico, Indonesia, Turkey, and many more. These nations are characterized by several key factors: a growing middle class with increased spending power, significant infrastructure development, and a transition towards more open market economies. They're attracting foreign investment, fostering innovation, and experiencing a surge in entrepreneurial activity. This translates into a dynamic and potentially lucrative environment for investors. But remember, with great potential comes inherent risk. Understanding these risks is crucial before diving in headfirst. In the next sections, we'll delve into the specific rewards and risks of investing in these markets, using real-world examples to illustrate our points. Stay tuned. Let's talk about Reliance Industries, an Indian conglomerate that exemplifies the potential of emerging markets. This company has its hands in everything from telecom to retail. Their expansion into the digital space with Jio has been phenomenal. Offering affordable data, they've attracted millions of subscribers. This rapid growth is a hallmark of emerging markets. Across emerging markets, companies are innovating and expanding. This translates into potentially massive returns for early investors. Now, let's address the elephant in the room: risk. Emerging markets are inherently more volatile than their developed counterparts. Political instability, currency fluctuations, and regulatory changes can all impact your investments. Take the Nifty 50, India's benchmark stock index. While it has shown significant growth over the long term, it's also prone to sharp swings. These fluctuations can be unnerving for investors and highlight the importance of a long-term investment horizon. Remember the 2008 financial crisis? Emerging markets were hit hard, but guess what? They also recovered faster than developed markets. This resilience is another characteristic of emerging markets. They're dynamic, they adapt, and they bounce back. The key is to understand that volatility is part of the game. Don't panic sell when the market dips. Instead, view these dips as potential buying opportunities. In the next section, we'll explore how technical analysis can help you navigate these market fluctuations and make more informed investment decisions. Section 5. Charting the course. Infosys and the language of technical analysis. Technical analysis is like reading the tea leaves of the market. It's all about identifying trends and patterns in stock charts to predict future price movements. Now, I know some of you fundamental folks might scoff at this, but hear me out. Let's take Infosys, a global IT giant from India. By looking at their stock chart, we can see trends like support and resistance levels, moving averages, and trading volume. These indicators can give us clues about where the stock might be headed. For example, if we see Infosys consistently bouncing off a certain price level, that might indicate strong support. Conversely, if the stock struggles to break through a specific price point, it could signal resistance. Technical analysis is not about predicting the future with certainty. It's about understanding probabilities and managing risk. By combining technical insights with fundamental analysis, we can make more informed investment decisions. Section 6. Beyond the balance sheet. HDFC Bank and the fundamentals of success. Fundamental analysis is the bedrock of sound investing. It's about looking beyond the hype and digging into a company's financials to determine its intrinsic value. Let's take HDFC Bank, a leading private sector bank in India. When we analyze their financials, we look at metrics like earnings per share, price-to-earnings ratio, and return on equity. These numbers tell a story about the bank's profitability, growth prospects, and management efficiency. A strong track record of profitability, a healthy loan book, and a robust capital adequacy ratio all point towards a well-managed and financially sound institution. This fundamental strength can give investors confidence, even amidst market volatility. Remember, investing in emerging markets is not just about chasing the next hot stock. It's about identifying companies with solid fundamentals that are well-positioned to benefit from the long-term growth of these economies. Now, let's put it all together with a real-time example. Tata Motors. This Indian automotive giant has been making headlines with its push into electric vehicles. As we speak, their stock price is fluctuating. Technical indicators might show us whether the stock is overbought or oversold. Fundamental analysis can tell us if their electric vehicle strategy is translating into increased sales and profitability. By combining these insights with an understanding of the overall economic and political landscape, we can make informed decisions about whether to buy, hold, or sell Tata Motors stock. This real-time analysis highlights the dynamic nature of investing in emerging markets. It's not a passive activity. It requires constant monitoring, analysis, and adjustments to your portfolio. Here's the bottom line, folks. Investing in emerging markets is not for the faint of heart. It requires a strong stomach for volatility and a long-term investment horizon. But for those willing to embrace the risks, the potential rewards are undeniable. The key is diversification. Don't put all your eggs in one basket, or in this case, one emerging market. Spread your risk across different countries, sectors, and asset classes. Consider investing in a mix of large-cap, mid-cap, and small-cap companies. Think about ETFs that track specific emerging markets or sectors. And don't forget about fixed income securities, which can provide some stability to your portfolio. Remember, investing in emerging markets is a marathon, not a sprint. It's about riding out the volatility and reaping the rewards of long-term growth. Ready to dip your toes into the exciting world of emerging market investing? Here's a simple 5-step action plan to get you started. 1. Do your homework. Research different emerging markets, understand their economic landscapes, and identify potential investment opportunities. 2. Determine your risk tolerance. Emerging markets are volatile, so assess how much risk you're comfortable taking. 3. Start small. Don't go all in at once. Begin with a small allocation to emerging markets and gradually increase it over time. 4. Diversify your portfolio. Spread your risk across different countries, sectors, and asset classes. 5. Stay informed. Keep abreast of global economic developments, political events, and market trends that could impact your investments. Remember, investing in emerging markets requires patience, discipline, and a long-term perspective. But with the right approach, you can potentially reap significant rewards. As we move further into the 21st century, the importance of emerging markets cannot be overstated. These economies are driving global growth, fostering innovation, and shaping the future of our world. Investing in emerging markets is not just about seeking higher returns. It's about participating in this transformative journey. It's about aligning your portfolio with the future of the global economy. So, do your research, manage your risk, and get ready to ride the wave of growth in emerging markets. The future is here, and it's full of opportunities for those bold enough to seize them.